Imagine a world where you can control a stock's movement even if it only moves a little. This is the intriguing realm of options trading, where strategies can be as delicate and precise as the wings of a butterfly. That's the beauty of options trading. It offers a variety of strategies to suit different market conditions and trader expectations. Today, we're diving into the short call butterfly, a strategy that lets you profit when you think a stock's price won't change much. This strategy is particularly useful in a stable market where significant price movements are not expected. Think of a butterfly with its wings spread wide. This strategy is similar. Just as a butterfly's wings are symmetrical, the short call butterfly strategy is balanced and precise. We use 3 different call options, all with the same expiration date but different prices. The middle strike price is where we expect the stock to settle, while the outer strike prices create the wings of our butterfly. This creates a sweet spot where we make the most money if the stock stays within a certain range. The potential for profit is highest when the stock price is at the middle strike price at expiration. The short call butterfly might sound complicated, but don't worry. It's a strategy that can be mastered with a bit of practice and understanding. We'll break it down step by step. First, we'll look at how to set up the trade, then we'll explore the potential outcomes and risks involved. By the end of this essay, you'll have a solid understanding of how this strategy works and why it might be a good fit for your trading style. Whether you're a seasoned trader or just starting out, the short call butterfly can be a valuable addition to your trading toolkit. Think of the stock market like the ocean. Sometimes it's calm, sometimes it's rough. The short call butterfly strategy thrives in choppy waters where prices swing up and down. Volatility is our friend here. The higher the volatility, the more potential profit we can make. Why? Because high volatility means bigger price swings, and our sweet spot widens to capture those moves. Remember, though, that volatility is a double-edged sword. While it can amplify our profits, it can also increase our losses if the market moves against us. That's why it's crucial to understand our risk tolerance and manage our trades carefully. The short call butterfly strategy isn't about betting on a stock going up or down dramatically. Instead, it's a sophisticated approach designed to capitalize on market stability. This strategy is particularly useful when you anticipate that a stock will not experience significant volatility. It's about finding profit in stability. Just like the calm sea, we seek to navigate through a market that is expected to remain tranquil, without major ups or downs. We use this strategy when we believe the market will remain relatively calm, with the stock price staying within a certain range. Imagine a tightrope walker. The tightrope walker must maintain balance and composure, carefully navigating the line without tipping too far in either direction. They don't aim for wild swings. They seek balance. Every step is calculated, every movement deliberate, ensuring they stay within the bounds of the rope. That's what we're doing here. By employing the short call butterfly strategy, we are essentially placing a bet that the stock price will remain balanced, much like the tightrope walker within our predetermined range. We're betting that the stock price will stay balanced like the tightrope walker within our predetermined range. This approach allows us to potentially profit from a market that is neither bullish nor bearish. This strategy is perfect for those who are neutral on a stock's future direction. It provides an opportunity to benefit from a market that is expected to remain stable, without the need for significant price movements. We don't need to predict whether the stock will go up or down. We're simply taking advantage of the market's expectation of limited movement. By understanding and utilizing the short call butterfly strategy, traders can find calm and potential profit in a neutral market environment. Every investment comes with risk, but the short call butterfly allows us to define our risk from the outset. We know the maximum amount we can lose, and that's it. No surprises. Similarly, our potential profit is also capped. We're not going to get rich quick with this strategy. However, with careful planning and execution, we can achieve consistent gains over time. Think of it like baking a cake. We follow a recipe, our trading plan, use specific ingredients, our options contracts, and bake it at a controlled temperature, our risk management. The result is a delicious cake, our profit, that's predictable and satisfying. The goal, growing your capital. The short call. Butterfly isn't about hitting home runs, it's about getting on base consistently. Our primary goal with this strategy is to generate steady income by capitalizing on the market's expectations of low volatility. Imagine a savings account that earns a little bit of interest every month. The short call. Butterfly is similar. We're not going to double our money overnight, but we can generate consistent returns that add up over time. This strategy is particularly well suited for investors who are looking to supplement their income or grow their capital gradually. It's a way to put your money to work for you without taking on excessive risk. Taking flight, entering the short call butterfly. Now let's talk about how to set up our butterfly net to catch those profits. The short call butterfly is a sophisticated options strategy that can be highly rewarding if executed correctly. It involves a combination of buying and selling call options to create a balanced risk-reward scenario. We do this by simultaneously buying and selling call options at 3 different strike prices, all with the same expiration date. This setup allows us to capitalize on the stock's price movement within a specific range. First, we sell one call option at a lower strike, which is the in-the-money option, meaning the strike price is close to the current stock price. This is our central position and serves as the anchor for our strategy. Then we buy 2 call options at the middle strike, which is at the money. This lower strike price option helps to limit our downside risk while still allowing for potential profit. And sell one call option with a strike price higher than the at-the-money call. This option is out of the money. This higher strike price option caps our potential profit but also limits our risk exposure. By strategically placing these options contracts, we create our sweet spot where the stock price needs to stay for us to make a profit. This sweet spot is the range between the lower and higher strike prices. It's like setting a trap for our butterfly. We want it to land right in the middle of our net. The key to success with the short call butterfly is precise timing and accurate prediction of the stock's price movement. With practice and careful analysis, this strategy can become a powerful tool in your trading arsenal. A graceful exit. Closing your position. Just like we need to know when to enter a trade, we also need to know when to exit. With the short call butterfly, we have a few options for closing our position. We can either wait until the options expire, hopefully with the stock price within our profit range, or we can buy back the options contracts to close our position before expiration. It's important to have a plan for exiting the trade before we even enter it. This helps us stay disciplined and avoid emotional decisions. Remember, a successful trader always has an exit strategy. Benefits of the short call butterfly. The short call butterfly offers several advantages for traders looking to profit from a neutral market. Defined risk. You know the maximum amount you can lose up front. Capped potential. While your profit potential is limited, it's still a positive return if the trade goes as planned. Neutral outlook. This strategy is ideal if you believe the market will remain relatively stable. It's important to remember that no trading strategy is foolproof. However, the short call butterfly, when used correctly and in the right market conditions, can be a valuable tool for generating consistent income. A final word on the short call butterfly. The short call. Butterfly is a powerful options trading strategy for investors looking to profit from a neutral market. While it may seem complex at first, by understanding the basic principles and carefully managing your risk, you can use this strategy to potentially generate consistent returns and reach your financial goals. Remember, knowledge is key in the world of trading. Before implementing any strategy, always do your research, understand the risks involved, and consider seeking advice from a qualified financial advisor. Happy trading and thanks for watching. See you next time, and do not forget to like and subscribe.